Good morning from the team of Deutsche EuroShop in Hamburg. With me in the call is our investor relations team. As you will have noticed, my colleague Wilhelm Wellner is currently taking a break for health reasons. However, he will certainly be listening to us today, and we wish him a speedy recovery. Wilhelm, we wish you all the best. Thank you for attending the presentation of our results for the first 3 months of 2022, with an update on the situation in our centers and on the development of Deutsche EuroShop Group. Let's start with a short update on our business activities, even though the situation has changed only marginally since our last conference call on the preliminary figures for full year 2021 6 weeks ago, which many of you have attended. So I do not comment further on slide 2 and slide 3. After 2 financial years overshadowed by the pandemic, we are confident that 2022 will be impacted to a much lesser extent. We expect 2022 to be a transition year on the way to a new normal, operational as well as in terms of how we deal with the coronavirus. Reliable forecasts are hard to make, however, given the uncertainty caused by the war in Ukraine. In March, various relaxations of the corona regulations in our foreign markets were helpful. In Poland, the Czech Republic and Hungary, there are meanwhile almost no restrictions. As of today, as you can see on slide 4, the mask requirement remains in place only in Austria for the time being. In Germany, the mask requirement was largely relaxed in the retail sector at the beginning of April and has been dropped throughout the country beginning of May. Since then, there is no longer any obligation to wear a mask for our customers and salespeople. Even though we are currently observing that many people are still wearing masks voluntarily and seem to feel safer at that moment. What happens in our centers? On slide 5, we take a look on our footfall. January and February were still heavily affected by severe restrictions in our main market, Germany. Just as a reminder, until mid-February, access to retail was restricted to vaccinated and recovering customers only. This means that you actually had to show your vaccination pass before entering a boutique, for example. This was a deterrent for customers and, of course, very complicated for retailers. Exceptions existed only for grocers and such like. In the first quarter, footfall was nevertheless able to reach a level of 70% of the comparable period pre-pandemic in 2019. Despite the invasion of Russian troops in Ukraine and the associated damping of consumer sentiment, footfall rose to a level of 79% in April. In summary, this means people are enjoying the regained shopping freedom and a certain normality. They are returning to the city centers, shopping malls and shops. Coming to the retail turnover on slide 6. Looking at our portfolio as a whole, tenant turnover averaged around 83% of 2019 levels in the first quarter, slightly lower at 76% in Germany. It is worth mentioning that the turnover in March developed slightly negatively in contrast to the footfall. This is certainly related on the one hand to the fact that people are more afraid for their own income perspective since the beginning of the war in Ukraine than they were at the peak of the pandemic. In addition, the propensity to buy is a record low and rising prices, especially for energy, leave less room for consumption. On slide 7, you can see our collection ratio since the beginning of the pandemic, which initially followed the pattern of a customer footfall and is strongly depending on the lockdown periods. The collection ratio represents the ratio of received to invoiced rents, service charges and marketing contributions after corona-related concessions. For 2021, the number was 95%. From the third quarter of 2021 onwards, the collection ratio improved further and is now closely to normality. In Q1 2022, the collection rate was 99%, with only very limited rent concessions granted resulting from some cleanup for 2021. We assume that the values for March and April will also be corrected slightly upwards, as experience shows that incoming payments can still be expected here, so that we should reach a level of almost 100% too. So far the update on the situation in our centers. I now come to the financial results of Q1 2022 and will start with the revenues on slide 8. These came out nearly unchanged at 52.1 million after 51.9 million in Q 2021. In contrast to the previous year, which was significantly affected by shop closures due to the pandemic, almost all our tenants were able to open their shops in the first 3 months in 2022. Looking at the bridge, you see that Q1 21 was influenced by temporary legal rent suspensions in Poland, plus 1.6 million. But the protective measures were still in place in the first quarter of 2022, and the continuing effects of the corona pandemic, such as defaults by tenants in payment difficulties, lower turnover rents, as well as longer relating periods and higher vacancy rates, mean that revenues are still below the pre-pandemic level. On page 9, we show you the development of our Ebit, which increased significantly to now 39.3 million euros, which is a plus of 24.9%. The major financial effect resulting from the pandemic last year was reflected in the allowances for rent receivables. These allowances were made in relation to realized and or expected losses of rents in connection with tenant support measures, for example, rent concessions, or in relation to de facto or likely insolvencies. In Q1 22, these allowances came down to 3.5 million compared to 11.9 million in the first quarter 2021. I now turn to page 10 and to the financial result. The financial result improved by 1.8 million or 23.7%. Interest savings of 1.1 million due to favorable refinancings for our Bildstedt Center Hamburg and our City Gallery Wolfsburg in June 2021, and an increased at equity operating profit of plus 2.3 million had a positive impact on the financial result. The minority profit share was 1.6 million lower. On slide 11, you see that the EBT adjusted for the valuation increased from 23.7 million to 33.4 million, which is a plus of 40.8% due to the high operating result, which was plus 8.6 million. Another positive impact came from interest savings. These amounted to 1.1 million euros. Let us look at the operating profit, the EPRA earnings, on page 12. The EPRA earnings improved by 8.2 million to now 31.3 million. On a per share basis, the EPRA earnings increased from 0.37 to 0.51 euros. I now come to the consolidated profit of the group on slide 13. The consolidated result increased from 22.3 million to 24.5 million. The main impact for the change came from a higher result from the standing assets, a plus of 8.1 million. Furthermore, last year's Q1 valuation result was influenced by the revaluation of an undeveloped plot of land. Correspondingly, the EPS increased to 36 to 40 cents in Q1 2022. Please follow me now to page 14 and to the development of the FFO, which excludes the valuation result. The FFO increased strongly from 22.5 million to now 31.3 million, or on a per share basis from 36 cents to 51 cents. The receivables are still on a more elevated level in comparison to pre-corona, but we are working with our tenants to recover. I'm now coming to the balance sheet on page 15, where you will only see small changes compared to the figures of December 2021. Our total assets amount to 4.3 billion euros. This is just a change of 22.1 million compared to with the reported date of end of 2021. Our consolidated liquidity as of end of March 2022 stands at 356.6 million. That is a plus of 72.7 million in 3 months. The build-up of cash was influenced by the normalization of the payment behavior of tenants. Total equity, including minorities, increased by 31.1 million euros. As at the end of the first quarter 2022, current and non-current financial liabilities stood at 1.5 billion, which was 2.5 million lower than the end of 2021, influenced by scheduled redemptions. Non-current deferred tax liabilities increased by 4.7 million to 337.7 million euros. Our equity ratio increased slightly and now stands at a solid 56%, and the consolidated LTV now stands at 29.7%. On a look-through basis, that is the LTV calculated fully proportionally according to the group share in all assets. The LTV now stands at 32.4%, also a continued very reasonable and low level. While earnings and profits are still below pre-corona levels, our balance sheet today is stronger than before corona. On the pages 16 and 17, we give you some information on our debt. Approximately 130 million or 8.6% of our consolidated bank loans expire this year. Currently, our consolidated debt bears an average interest rate of 2.08%. The weighted maturity of our loan portfolio now stands at 5.2 years. Including our non-consolidated loans, the weighted maturity of the portfolio now stands at 5.4 years, with an average interest rate of 2.05%. On the right side of page 17, you will see that we have fixed a loan of 107 million this year, and I'm very happy to tell you that we have yesterday signed a new loan agreement in the amount of 52.2 million euros for our city point in Kassel for a duration of 10 years. Looking at the digitalization process in the retail business on page 19, 18 of our 21 shopping centers already have this valuable link to the omnichannel world. While the online availability check is now working for more than 1,000 shops and 3.7 million products in the ESG portfolio, set up and testing of deliveries out of the center is an important task as a preparation for serving the delivery out of the center. An exciting and promising pilot project is currently underway in a shopping center from the EC portfolio in Hamburg. The digital mall project is now ongoing with 65 centers live in total. You can see an extract of the participating partners at the bottom of the slide. Right for the start of the summer, we got good news from the Main-Taunus-Zentrum, which you can see on slide 20. The demolition work for the former Karstadt building has been completed. In our last call, we already showed that we are working on a promising solution with an attractive gastronomy and entertainment offer. In the meantime, we are using parts of the site, which is located in the heart of the center, for at least 1 year to offer visitors a completely new urban lifestyle atmosphere. Under the name Food Trucks 365, a varied program of different culinary offerings is offered here, which will be constantly changed. The new offer was already very well received in the first days of opening. Finally, I would like to come to slide 21 and look at the transaction market and the financing activities. Financing first. As mentioned, we have already agreed with the banks on a 107.4 million loan with 10 years maturity and a fixed interest rate on 2.45% to refinance a loan for our Altmark Gallery in Dresden that became due end of March 2022. And as already said, we signed also yesterday a new loan in the amount of 55.2 million euros for a duration of 10 years for our city point in Kassel. Interest rate is 3.81%. Is 3.18%. So currently we are working on 2 additional loans with a total amount of for this year we are working for 1 loan with a total amount of 52.1 million euros becoming due in 2022 and 209 million euros becoming due in 2023. I'm optimistic that we will fix the new loans within the next weeks and the loan for 2023 in the third quarter this year. While the number of banks looking at retail real estate financing, for example shopping centers, has decreased, we have received good interest for our refinancings in the market. We continue the regular dialogue with our banks about the impact of the pandemic on our financial covenants. Until the reporting date, all our financial covenants were met. The transaction market has been, not surprisingly in the given situation, rather dry. However, there are signs that the transaction market is slowly coming back, even though it is currently again affected by the terrible Ukrainian war. The shopping center Boulevard Berlin was sold end of 2021 and Gera Arkaden in Gera, Germany in the first quarter 2022 at, as we have heard, fair prices. If the impact of the Ukrainian war on investors and their financing banks stays limited, one may expect to see some further transactions. As we hear from the market, some transactions are currently being prepared. The yield differential between shopping center assets and the other real estate asset classes, for example office, residential and logistics, seems to be just too big to be ignored. The spike in interest rates may support the shift of demand among real estate asset classes. Finally, let's come to the financial outlook on slide 22. We expect total funds from operations of 1.95 to 2.05 euros per share for the 2022 financial year, which still will be, in our expectation, a transitional year on the way to a normality of after Corona. Accordingly, we have applied a bit more cautious assumptions on rent write-offs in comparison to pre-Corona times. This forecast again assumes that the pandemic situation can be brought under lasting control without further store closures or significant restrictions on center operations, a continued uptick in private consumer spending, and an associated further recovery of the tenant turnovers, as well as the preservation of recovered high collection ratios. The war in Ukraine may have a negative impact on consumer behavior, supply chains, and ultimately our business. This not has been reflected in our forecast, as the potential impact cannot be estimated at present. We do not see it in the figures yet. After the intended fixing of the refinancings 2022 and 2023 this year, no further loans fall due before 2025. It's only 58.3 million euros in September. Ladies and gentlemen, we remain optimistic as before, even though there's still some way ahead of us. So far my presentation. Thank you for listening. I'm happy to take your questions now. Operator, please take over.
Ladies and gentlemen, at this time we will begin the question and answer session. Anyone who wishes to ask a question may press star followed by 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star followed by 2. If you're using speaker equipment today, please lift the handset before making your selections. Anyone who has a question may press star followed by 1 at this time. One moment for the first question, please. And the first question is from the line of Marcus Kolessa from Bank of America. Please go ahead.
Yes, good morning. Thank you very much for the presentation and for taking our question. I would have 3 questions. You want me to do them one by one or at the same time?
Yeah, just one by one is the best way, I think, Marcus.
Okay, so the first one is on the guidance for the full year. If I just annualize your Q1 EPS or FFO, this would imply no further improvement in the following quarters. Is this due to a conservative view, or is there specific reasons which would mean your, especially H2, would be then below last year?
I think it is the most realistic view which we have. We had said that we have a cautious look on Corona, and we have the impact currently not seen from the Ukrainian war, but we still feel very comfortable with this forecast. We got a new forecast from ECE after the first quarter, and so we still can stick to this forecast. I think it's the most realistic view.
Okay, thank you. The next one is on the like-for-like rent growth, which was flat if I look at your gross rent in Q1. I wanted to know what the indexation was in Q1, because I suppose it was positive, and what has been the effect compensating on the other side?
Our inflation or indexation is every 2 years. So the impact is not very big in the first quarter 2022. It's roughly slightly below 1%. We will see hopefully a bigger impact in the coming 9 months if inflation is still very high. But at the end, that is also what we have to see. Indexation is very helpful for us, but we will see at the end whether we can push this through with our tenants over the time.
Okay, thank you very much. Then on if you can share how your valuers will take into account or take generally into account the rising rates. And maybe a bit related question, you said you saw fair prices for the transactions in the market. Maybe you have an idea of the yields for the recent transactions, like Gera Garden?
Yes. That are all market rumors, and so I do not want to comment on deals of third parties. You have to ask Unibail-Rodamco. As what we have heard, we feel very comfortable with our evaluation, for example, for the Rathaus Center in Dessau, which is very comparable to the Gera Garden. So we see that's the reason why we call it fair. And also for Boulevard Berlin, yes, we have heard a figure, and we also feel comfortable with this. But I ask for your understanding that I comment on yields which haven't been published by sellers and buyers.
Okay.
When you asked about interest rates, I'm very happy to tell you that we will be able to reduce our average interest rate also this year. We have refinancings already done. Altmarkt Dresden, the old interest rate was 3.45%. The new one is 2.45%. That's what we have said to you. Then City Point Kassel, the old interest rate 2.95%. The new interest rate 3.18. So it's higher. But on average, I assume that we will be cheaper for all the refinancings in 2022. So our estimate is that our interest payment 2022 will be 2.5 million euros lower than the payments in 2021. Regarding the matching loan 2023, the actual interest rate 2.99%. According to the actual indication, we are slightly lower to that, but perhaps it will be the equal, and then there's no reduction.
Okay. Thank you very much.
Thank you, Marcus.
The next question is from the line of Thomas Rothäusler from Deutsche Bank. Please go ahead.
Hi, morning, everybody. Two questions. One on, the turnover actually came down most recently relative to footfall, and I think you referred to first impacts from weaker consumer confidence. What is your expectation here looking ahead?
Yeah, that's a good question, Thomas. But you're right. In the pandemic, we saw that turnover performed better than the footfall, and now since roughly 4 weeks, it's vice versa. As said, we currently cannot figure this, but we have to be cautious on that. And as also already said, even if inflation is helpful with indexation, at the end, we have to see whether we can push through this with all the tenants. Because at the end, the turnover of our tenants is the main topic for paying leases.
Okay, and the second question I do have is actually on Capex. Can you provide any update on Capex measures, and do you stick to the budget? I think you've said it's 40 million annually. Is it right?
Yeah, you're right. So we start all our Capex measures this year. All what we have planned for 2020, 2021 is now starting. And yes, the figure is still that we want to invest between 30 to 40 million euros for more beautification at your service and Capex in the next years. And yes, that is what we are kicking off now.
Do you
that is also, perhaps let me add that, Thomas, that is also one reason for our high liquidity. We are very cash rich, roughly 360 million euros. But keep in mind, we haven't done any Capex in the last 2 years, and we want to spend 30 to 40 million euros Capex per annum in the next years.
Do you already sense some, some supply constraints with regards to maybe labor or material on refurbishments? Or it's obviously currently a key topic here in the market, and also on construction costs. Maybe you can comment.
Yes, we have to expect this due to the current situation. perhaps we have also experiences already in 2018 and 2019 due to other reasons, but currently we haven't heard from ECE that we get problems, but we have to expect that we can't spend all the Capex amount which we are planning. As said, and that's the reason why I told you that we are hopefully spending 30 million and not the expected 40 million euros.
Okay, got it. Thank you.
You're welcome.
The next question is from the line of Manuel Martin from Oddo BHF. Please go ahead.
Yes, hello. Thank you, gentlemen, for taking my question. I've actually two questions, maybe one by one. First question is on the leasing situation. Could you give us an impression or a feeling how you see the reletting situation in your shopping centers, the decrease of vacancy rate in the future, and also the level of rents when you relet vacant spaces? Maybe you could give us some color or feeling on that, please.
Yeah. At first we can tell you after the first 3 months that our reletting results are according to our plan. But reletting is still difficult, especially negotiating lease agreement with the big tenants, with the big fashion retailers is very difficult, takes a long time, and we have to do a lot to keep them in our shopping centers, and we have to reduce rents. At the end, also due to the full reletting activities reducing vacancy, we believe that we can stick to a rent level like in 2021 at all, at the total amount. Retailers are immediately more optimistic and positive if turnover is running better. So we have expected end of 2021, in the first 2 to 3 months this year, that retailers are more optimistic, are willing to sign new lease agreements also for 10 years. It's not like you read in media that's only 5 years. That's not true. It's mostly 10 years. It's very often we see possibility to cancel after 5 years. Yes, that's true. But we still have our standard lease agreement with a minimum rent. We only have 1 or 2 lease agreements in our total group in which we have agreed with the tenants only on a turnover-based rent. Mm-hmm. So it's currently better than in the last 24 months.
Okay. Okay, thanks. Second question is, it's somehow related. It's on the write-downs of French receivables allowances. What's your feeling there? Can we expect a decrease of write-downs over the remainder of the year?
Yes, we have. We believe that for this year we have a cautious assumption on that, that is an amount which is half of that what we have realized last year. And also for 2023 and 2024, we see a further reduction in the write-downs. And starting with 2021, we expect normal levels.
Okay. Thank you very much.
You're welcome.
So there are no further questions at this time, and I hand back to Olaf Borkers for closing comments.
Yes. Ladies and gentlemen, thank you very much for listening, hearing our news, and I wish you a nice and sunny weekend. See you in June at our hopefully at our annual meeting or in our next conference call. Bye bye.